A good alternative as well is potentially downsizing your property and then looking at gifting the surplus cash from that. That can be a safer way to pass on wealth to the next generation without entering into what is a complex area.
Welcome to Listen Without Prejudice, the podcast from Bishop and Sewell. Each episode brings you expert insights, practical advice, and real stories from one of London's leading law firms. From property and private client matters to business law, family, and dispute resolution, we're here to inform, guide, and inspire. Let's get started.
Hello, I'm Nicholas Barlow, head of the private client team at Bishop and Sewell, and today I'm joined by Luke Jenkins, an associate in the team who's just completed his exams with the Society of Trust and Estate Practitioners, so the perfect person to speak to about gifting the family home. So Luke, it's a classic question that we're often posed with: can I give my home away to my children and save inheritance tax? And usually there's a disappointing answer.
Yes, we often get asked this by clients. They think, great, I can just pass over the deeds to my property, to my children. I stay there and there aren't any consequences. But unfortunately, we have to be the givers of bad news. Unfortunately, there are a number of both practical and taxable implications when clients are seeking to do this.
So it's a matter of property law. I mean, they can change the ownership. But
yes.
What we're thinking about here is the tax consequence of doing that, because usually the aim is to enjoy the comfort of living in your home, but not have to suffer the tax burden on death.
Yes, it's a concept brought into legislation around 1986. So government was looking to stop people sidestepping inheritance tax by handing over the title deeds to their children.
So that's a gift with reservation of benefit.
Yeah, the key concept.
A phrase we often use.
So the key concept is known as a gift with reservation of benefit. I said introduced into legislation in 1986. But what it basically boils down to is that if you attempt to give away your family home and remain there without paying any rent, then the value of that asset is frozen within your estate on death.
Even though you don't own it.
Yeah.
You've got to pay the tax out of something else.
Yes, and it can be a nasty shock for the executors of the parents' estates. They might not have anticipated that the parents had done this without taking proper advice, and therefore they end up with a much larger inheritance tax bill than they had previously anticipated.
Yeah. And the gift, if it was made within 7 years of death, would then mean that the recipients are going to have to pay the tax, so they might even have to sell the home that's been transferred.
Correct. Yes, and again, that's having the complete opposite effect to intention that they had in the first place.
Yes, yeah, absolutely right. You mentioned about paying rent to live in your property. So how does that work? Do you just pick a number, or what would be the way of doing that?
No, so we would suggest taking proper advice, so getting a market valuation, which is reviewed ideally on an annual basis, and then that rent is paid effectively as if you were a tenant from the open market. And the revenue will closely scrutinise these arrangements. So again, our advice would be to obtain the proper valuation, make sure that is reviewed at least on an annual basis, and then good records kept. So when you do pass away, your executors can present the information to the revenue with a better chance of succeeding.
Yeah. So if someone's entered into a rental agreement, they have to pay the rent throughout the period they're occupying the property, not just 7 years. That's correct, isn't it?
Yes, that's correct. And if they stop paying the rent, then you are at risk of it becoming a gift for reservation with benefit. And then, as I mentioned earlier, that value of the asset being frozen in your taxable estate on death, therefore unravelling all the planning that you've done prior to setting up that arrangement.
So if there are significant care costs, even though rent could have been afforded at the outset, if in later life income's being spent on care, it may be impossible to carry on with the rental arrangement.
So looking at it from a care perspective as well, another practical implication is that a care authority may look at this as a deliberate deprivation of assets.
So giving them away to avoid having to pay.
Exactly that. And so you are at risk then from that point of view of that asset being counted within your capital when being assessed for care fees.
So going back to the rental arrangements, we have seen those work quite successfully. We've got clients with generous final salary pensions. So they actually have got the income. They're paying rent to their children. Presumably the children have to pay tax on that.
Yes, that's correct. So another practical implication is that the children would have to pay income tax at their own marginal rate. So again, that's another bit to think about when putting these arrangements in place. But like you say, we've seen them work successfully. We've managed to remove a large amount of capital, i.e. the main residence, out of an estate, whilst also utilising surplus income and passing this on to the next generation. And it can work quite successfully and bring down the inheritance tax bill when looked at properly.
Yeah. Yes, and the other question we were asked after the initial one about gifting the house is, with the rent, can we just give that back to mum and dad? Now, that's something the revenue are going to be keeping an eye out for.
Yes, and that's very much off the table, unfortunately. It really has to be genuinely given and, forgotten about, given to the children. It can't be, provided back.
I mean, where we have seen an increase in these arrangements, and certainly after COVID, when perhaps children were moving into the family home with their parents to provide care and support, and there was genuine co-occupation. So that works, doesn't it?
Yes, that works. And there are examples also where you give away a particular share of the property as well, if somebody is genuinely living with you. And then you need to look carefully at what you're contributing in line with your share that you've acquired in the property, which again, we can advise on.
Yeah. So that's where property has perhaps been split into flats and you've got a granny annex or whatever it might be. That will work. But to say, it's making it very clear on the documentation that it is co-owned.
Yes, and that there's divisions of the property and so forth. Yeah.
The issue comes up, of course, if people are looking at equity release, if they've made a gift of a share of the property. So that would scupper that chance.
Yes. And then a good alternative as well is potentially downsizing your property and then looking at gifting the surplus cash from that. That can be a safer way to pass on wealth to the next generation without entering into what is a complex area.
Yeah. Now, I had a discussion with a family of clients the other day, and there's a lovely home, and the current occupier was very keen that it was kept, but her two daughters said, well, we're not going to live here together, so it will be sold at some point in time. So perhaps a lifetime sale, although an unhappy prospect, is something that needs to be dealt with, and that will free up some cash. And once you've got these arrangements in place, when you've made the gift, presumably you need to update all the paperwork for insurance and all other aspects of the property.
Yes, that's key. So we really you need to look at putting in potentially also a tenancy agreement to ascertain who is responsible for what. And like you said, updating the insurance to ensure that it's in the correct names of the owners. And again, another fallout of not putting these plans in place without seeking professional advice is that you need to be happy that the person isn't going to then later down the line sell the property, or like I said, if it's not insured properly, that it suffers damage which can't be paid for. And also in this day and age, we're seeing more and more people get divorced, for example. So you might look to give away your property to your children, but then if they then get divorced, there is a risk that property could be part of divorce proceedings potentially.
And whenever we do an inheritance tax analysis, the first option is do nothing. I mean, the people who are living in the property, it's their home. They bought it, they've paid off their mortgage, and they enjoy it. There may not be a wish for them to give that away, but if the family as a whole wants to try and save some inheritance tax, and if there is the ability to have the rental agreement in place and pay the rent throughout, it can be an effective tool.
Definitely. And I think a lot of people forget as well that there are inheritance tax allowances. We've got the nil rate band, which is £325,000 at current rate. Also the residence nil rate band of £175,000. So there are those allowances in place on death to be used. And like you say, it from a day-to-day perspective, whilst it might be a tax saving, you might not simply want to leave the family home, which you have fond memories of.
Yeah. I mean, another position we've taken is looking at whether perhaps a very small share of the property can be given away in order to have the discounting effect of co-ownership. And you could just explain how that works, where you've got someone else who owns a share in property.
So when we value a property at death, we obtain a red book valuation from a surveyor, which is a tax valuation. And if you have a property which is co-owned by two or more people, there's a discount available potentially of 10 to 15%, depends on the circumstances, So again, not many people are aware of that, but that is a nice tool to utilize on death, which will again lower the value of the property.
So you could give away less than 10% of the property, but have a discount of at least 10% of the share that you've retained.
Yes, in reality, it would produce an even greater saving than first realised.
But again, the new co-owners can need to be on the deeds. They'd need to be all recorded in a declaration of trust at very least, and be on the insurance policy and have all of the characteristics of an owner.
Yes, and that's something we very much assist with. We produce declarations of trust them day in, day out, and they have a multitude of uses. But I said one of them is very much identifying who owns what with regard to a property, who's responsible for what, and any other contributions that might have been made. So, for example, you might have given away a share in the property, but then you might have contributed, for example, with a new kitchen or an extension. So again, the declaration of trust isn't just a document that is created and left. It can be added to moving forward if the new co-owner does contribute in other ways.
So they're acquiring an extra percentage point or two.
Yes, exactly that.
Yeah, wonderful. Well, so just to summarize, whereas our original answer was no, you can't do it, in reality, there are opportunities for gifting part of the family home or indeed all of it. But it would need to be a question of genuine co-occupation, all paying a full market rent, and the recipient of that rent paying tax on it and declaring it. Some families that does work, and it can be a really effective tool, but bearing in mind the risk, as you identified, of the new owner of the property then falling into financial difficulties or matrimonial difficulties. It's a reminder that good advice will certainly help try and save tax. Thank you very much.
That's all for today's episode of Listen Without Prejudice. Whether you're navigating a property transaction, a corporate, commercial, or family matter, we're here to guide you every step of the way. If you enjoyed the episode, don't forget to subscribe to stay up to date on future episodes, where we'll continue to explore the latest trends and challenges across our core practice areas. Do you have a question or topics you'd like us to cover? Or do you want to reach one of our experts? Feel free to get in touch via LinkedIn or through our website, bishopandsewell.co.uk. Thanks again for tuning in. Be sure to join us in our next episode, where the conversation continues. Until then, take care.